Hey guys, welcome back to another exclusive podcast from IronFX. At IronFX, we are dedicated to bringing you the absolute best trading education to help you take your trading to the next level. In today's podcast, we're going to talk about moving averages and if there is an absolute best single moving average to use when trading the markets. Now, some of the common moving averages that are used when trading the markets is the 20 moving average, the 50, the 100, the 200 moving averages, and each one of them, they're used to interpret the markets in a different way. The shorter the moving average, the more closely it follows price. And the longer the moving average, that's where it tends to be separated from price a little bit more. You know that when price is touching a 100 moving average, there's usually going to be a little bit of a reaction there, right? If price is touching, for example, the 200 moving average, right? Usually you can expect a little bit of a reaction, right? So one of the common questions I get is there a particular moving average which is the best, right? The one that the market always tends to respond to the best, all right? To answer the question, right, the first thing we need to know is that the shorter the moving average, the less reliable it tends to be, right? Because you can imagine that there's so many touch points. If you have a moving average value of about 10, for example, right, that's where the markets are. It's following the markets really closely. And there's so many times that it's going to touch the market, it's going to cross above it, it's going to cross below it, it's going to touch it, right? And that's where it becomes a little bit less reliable, right? So as with most forms of technical analysis, when you reference the higher time frames or the little bit, you use a little bit longer history, right? That's where you tend to get slightly more reliable results, right? So that is why people often highlight a big event like the 50 moving average crossing below the 200 moving average. I believe we call that a death cross. Or a 50 moving average moving above the 200 moving average. You call that a golden cross. Rarely will you hear about, the 5 moving average cross below the 10 moving average, right? Isn't of much interest to people. People are usually looking at the bigger moving average and moving averages, right? Just so to answer that question, usually you need to look at slightly larger moving averages. So now that we have established that we are looking at maybe the 50, the 100, the 200, is there then a particular moving average that works better than the others? To answer this question, we first need to ask ourselves, why in the world are we using a 100 moving average? Who decided that 100 is the correct number to use? Right? Who decided that 50 is the correct number to use? Who decided that 200 is the correct number to use? Right? If you think about it, is there someone out there that actually set the big rule that the 50 moving average or the 100 moving average has to be a 100 moving average? Right? So one of the tricks that I learned back when we are in an institutional research house is that always question everything that you know about markets. Right? So this led us to question, like, okay, it's 100 moving average, but what if I actually tweaked it a bit, right? What if I adjusted the moving average so it is a 90 moving average or is a 95 moving average? What if I play around a bit and see what the market tells me, right? So this is what we actually call the natural moving average. We're trying to find the moving average that fits the market the best, right? And when we did that, we realized that more often than not, the 100 or for example, the 100 moving average is not the best, right? But if you just tweak it a bit, maybe the 95 or the 105 moving average tends to capture the movements of the markets slightly better, right? You can imagine that if prices is just imagine that price is above the 100 moving average, right? And as it comes down, right, and it finally touches the moving average, the ideal way which you want to see it bounce off is that you want to see price touch the moving average and bounce right away, right? So if you have a 100 moving average and you realize that price touches it, but it goes slightly beyond it, right? Then you might be thinking, okay, maybe the 100 moving average is a little bit too sensitive, right? And you tweak it a bit, right? You move it to 105, 100, 110. Then you realize that, whoa, 110 moving average, right? Price touches it once, it bounces up. And the next time it touches it again, it touches it right on the dot, right? And touches it and it bounces up. then you realize that the market is actually responding to the 110 moving average instead of the 100 moving average. Okay, this is an important thing that you need to grasp. That firstly, you need to ask yourself, why are you using a certain number? Why are you using 50? Why are you using 100? And once you come to the realization and the acceptance that, is no one actually is forcing you to use that, that is where, you'll be open to actually tweaking it around a bit and actually looking at what the market is telling you, right? The market will not look at you, for example, euro dollar, right? They're not going to look at you and say, yeah, you know what? Because everyone says the 100 moving average is the de facto standard, right? Then I am going to respect the 100 moving average. But the market doesn't care. The market doesn't care that everyone thinks the 100 moving average is important. It behaves the way it wants to behave, right? So to be one step ahead of the market, you always need to question everything you see about the market, right? Everything that you are led to believe, right? And this also leads to the next point, which is is the simple moving average, the only moving average that you should use, right? And this is one thing which I also have to encourage you guys to do, right? Which is after you play around with the numbers, maybe the 50, the 100, 105, 95, right? After you play around with it, the next thing you need to play around is actually play around with the type of moving average, right? Maybe you realize that a weighted moving average works slightly better, right? Maybe you notice that exponential moving average works better than a simple moving average. There are a couple of moving averages out there, which you can explore. But there is one thing I want you to do too, right? Which is to take a different approach, take a more flexible approach to the types of moving averages and the size of the moving averages that you're using. All right, so long answer to a short question on what is the best moving average to use in the markets. The answer to that is that there is no best moving average, and instead to find the one that fits the market the best, fits that particular instrument the best, right? So we're talking about not just like euro dollar, because the moving average they find on euro dollar, maybe 105 works very well on euro dollar. It might not work so well on gold, right? It might not work so well on crude oil, right? So you need to find the natural moving average of not only each market, but each time frame, right? Because it differs from the 4 hours to the 1 hour to the 1 day to the 1 week, right? Each one, the market behaves differently across it all. So it's going to take a little bit more effort. You can't just plug in a simple 100 moving average and expect everything to behave, perfectly. It's going to take a little bit more effort for you to fine tune it, right? But once you kind of get the hang of it, then you realize it unlocks a whole world. It helps you unlock a whole new way of looking at the markets. Anyway, guys, that's it for me for today's podcast on what is the best moving average to use when trading the markets. I hope you found it useful in improving your trading strategy. Do remember to subscribe to our podcast, as here at IronFX, we are dedicated to bringing you the very best trading education to take your trading to the next level. All right, that's it from me. Stay safe, trade safe, and peace out, guys.